This is Barry Knapp with Ironsides Macroeconomics. It's Tuesday morning, May 28th at a little after 10 a.m. Mountain Time. Our report this week was titled Waller's World. You're listening to or watching the complimentary introductory version of our weekly summary of our weekly note. And this week's note was titled Waller's World. That's a reference to Fed Governor Waller, who gave a fascinating and ultimately, if you read between the lines, important speech on the esoteric concept of R starred, or what is the equilibrium monetary policy rate. And he also gave an interesting interview on CNBC last week, which gave some pretty decent clues into how the Fed's likely to respond to incoming inflation on a go-forward basis. So we talked in the note a little bit about the environment last week, discussing NVIDIA and the blowout results. We'd been in New York on what we're calling a field trip, but seeing a bunch of investors, and we didn't find too many skeptics of the Gen AI investment boom. But we did have a risk-off day coming from FOMC minutes, and those minutes, which some were initially quick to dismiss because we'd gotten some soft inflation and labor market data after that FOMC meeting, we don't think that's the right read. In fact, we do think those minutes, which are typically heavily redacted, did probably reflect the meeting better than the chairman's press conference did. And this was a reasonably hawkish Fed. So we had a one-day risk off, and then markets went back to just focusing on the Gen AI boom. Our meetings last week, the general consensus was people are long tech. People like our idea of being long industrials and energy, materials, sectors like that. And within fixed income, we suggested not extending beyond 2-year notes. And even that auction didn't go particularly well today. It traded a basis point through the WI price. We didn't get too much pushback on that either. So that does leave one potential vulnerability. And the chart I have up here for those looking at the video shows you the Conference Board's labor differential survey. Jobs plentiful has fallen reasonably sharply after a little bit of a bounce at around the turn of the year, and is consistent with an unemployment rate well above 4%. That is the one thing that would get the Fed started on a fairly aggressive rate cutting cycle, even with above target inflation, would be a deterioration in the labor market. We've maintained all along that this Fed will get weak knees if the unemployment rate goes above 4%, our so-called quadrilemma thesis. So the Waller speech was fascinating, and we do think that, combined with a speech that Michelle Bowman gave in Tokyo last night, Governor Bowman gave in Tokyo last night, does mean that there is a growing constituency in the FOMC who would like to see the Fed reduce the duration of their portfolio and have less impact on the longer term part of the Treasury market. We do think that will be part of the review. The Kansas City Fed announced the title of Jackson Hole, Reassessing the Effectiveness and Transmission of Monetary Policy. I think there's going to be a big discussion about the Fed's role in the pricing of the most important price in the global capital market system, that's 10-year Treasury. So that's an important concept. We also took our first run at what policy is going to look like after November. And just a couple of quick comments on that. One is that it's the lowest probability outcome is a Democratic sweep. Most of the analysis we've seen assumes that the Senate will flip to the Republican Party. So the tail event in 2016 was a Trump victory, but that Trump victory meant a cut in the corporate tax rate that was a big net plus for equities. This time around, there's probably a similar probability of Biden winning and sweeping, meaning he also takes the Senate and the House. The House will probably go with whoever wins the presidency, but the Senate, the math is very tough for the Democrats. But were that to happen, we could have a very negative tax outcome with an increase in the corporate tax rate and an increase in capital gains rate. So the range of outcomes and around a whole range of topics, inflation and the like, are skewed negatively this election. Generally, elections breed optimism, but we think the range of outcomes is skewed more negatively going into this election. And so it's hard to be too optimistic about the 2025 fiscal policy outlook. But if you want all the details, become a full subscriber to our note and they'll be there for you. We'll get into it. It's a fairly nonpartisan take. We're just looking at taxes, spending, immigration, all the things that affect the economy and markets. So that's it for me this week. Barry Knapp from Ironsides. Have a good week, everyone. And as I said, consider becoming a full subscriber. Thank you.